finally, we're going to talk about some cash and investment analysis. These are ratios you're going to want to know, right, for your exam. I would imagine the large part of your testing from Chapter 8 will come from cash and investment analysis. We do like to focus on can you make decisions with this, right? How are you using to make decisions? So there are a number of reasons, I mean hundreds of reasons why a company might hold on to cash. Okay, while they're holding on to it, they're not doing anything with it. It's just sitting there, okay? We may be able to explain why one holds more than another. So are they a growth company, right? If they're a growth company, they're typically going to hold less cash. And by growth company, I mean, are they constantly expanding? Are they constantly doing new things, entering new markets, that kind of stuff? Is they're changing technology? Tech companies typically have lower cash amounts that they're holding because they have to keep up with technology. Volatility of operations, how risky are their operations? Foreign operations, foreign currencies fluctuate in value constantly, right? So a dollar is not always worth the same from country to country to country, from day to day to day. If you're an accounting student, you will learn much more about foreign currencies and the transactions involved there when you get to Accounting 301. And then also, do they have a dividend policy? Companies that have a high dividend payout, companies like GE or Ford that pay out every quarter and they pay out cash dividends every quarter, they've typically got lower cash on hand, okay? You can compare how much cash they have from time across time. So meaning, this is your time series analysis across companies. This is going to be benchmarking, right? You're going to be benchmarking against competitors. You're going to be benchmarking against industry, that kind of thing. This note is important. It can provide flexibility and a bit of a safety net if you hold on to cash. But what it does, what we look at as accountants is it forgoes the opportunity to earn any actual return on cash, right? And if you're a finance student, that's going to be a big part of your analysis later on in classes, right? So don't hold on to cash, because that cash, you're not making money with it. And everybody knows that the best way to make money is with your money. So the first ratio we'll look at is the cash holding ratio. Okay, so you're going to take your cash and cash equivalents. This is from your balance sheet. And you're going to divide it by your total assets. Again, from your balance sheet. Notice it's not average total assets. It is just total assets, because these are both balance sheet accounts. Okay, so they're in the same time frame. So let's say, for example, Microsoft has $8,759 in millions in their cash and cash equivalents account, and $258,848 in millions of total assets. Okay, that is how we would calculate their cash holdings ratio. Basically, this is cash is X% of your assets. Okay, and that just tells us you are holding on to this much cash. This cash is just sitting around. Okay. So if we look at the cash holding ratio for Microsoft and their other peers, we can see Microsoft has a much lower cash ratio, right? Than like Google or Apple. Why? Well, you may want to look at their 10K, and you can identify differences in their policies, differences in their procedures. Maybe Microsoft pays way better dividends than Apple does. Maybe they're investing in more markets than Apple does. Whatever the case is, we will see later what the case really is as far as why. Okay. The next ratio we're going to talk about is investment to assets ratio. Okay. And again, these are all balance sheet accounts, right? So we don't have to use any averages. We can just use the total. So your investment to assets ratio, we're going to take short-term investments plus long-term investments, and we're going to divide that by your total assets. Okay. So again, we've already knew Microsoft's total assets number. You could go in the 10K and find their short-term and long-term investments totals, and this is going to give you your investment to asset ratio. This is going to tell you what the level of investment is that you are making relative to your assets. Okay, it allows you to see whether or not a company may or may not be over or under invested in securities of other companies. Okay. So again, we can take a look at a graph and say, okay, Microsoft and Google, they're pretty even, but Apple, man, they are way, way invested, right? So it may be that Apple is way over invested in equity. So what happens, right? if some of these companies that Apple's invested in crash, right? Well, they lose a lot of these assets, right? They're going to lose a lot of investment assets because remember, they've got to make a fair value adjustment to that. Okay, so it could also mean that Apple's just paying out fewer or smaller dividends to shareholders, which would cause issues. It could cause issues. It did cause issues. There was a billionaire who sued Apple several years ago because Apple, he kind of ran this kind of analysis and noticed they're just not paying dividends. They've got plenty of money to pay us dividends. They should be paying more dividends. Okay. And then finally, we have our return to investments ratio. Okay, this should be on. Sorry about that. We have the return on investments ratio. Okay, this one we are going to use averages. Okay, why? Well, this is the income statement and this is the balance sheet. Okay, it's a loss. You look at this and you think, oh, this is an asset. No, this is just the account associated with that loss. So they're just saying related income loss from investments. That's a loss. It goes on your income statement. So we're going to divide by average short-term and long-term investments. Okay. And we will find that their return on investments ratio, is 3.5%. Okay. So what this really just tells them, what's our income statement impact on the investments that we hold by the company, right? So Microsoft's is fairly low, okay? If we had to decrease the value by a fair amount when we were doing our adjustment, it doesn't have a huge impact on our income statement. That's all it's telling us, right? Because in the end, what are most investors interested in? Net income, right? Net income, if you read the book, is a good way to look at share prices. Okay. Net income is a very important number. So we want to know how are our investments impacting our net income. Okay. All right. Well, that is it for Chapter 8. If you have any questions, please let me know. I am happy to answer them.